At first, nothing feels broken. The peaks still slice into the sky like they always have. Snow still gathers softly on rooftops that cost more than most families will earn in a lifetime. Chairlifts still glide. Chimneys still breathe smoke into the thin alpine air. Glass walls still glow at night, reflecting a version of perfection that looks untouched by reality. That's how fragile systems survive. They don't collapse with noise. They don't shatter in public. They decay quietly. It starts with homes that don't sell, with listings that sit just long enough to make sellers uncomfortable, with price cuts that appear small, polite, almost apologetic, with towns that look alive on weekends but feel abandoned from Monday through Thursday. Colorado's mountain communities weren't just selling real estate. They were selling immunity, a promise that gravity worked differently at altitude, that scarcity alone could defeat economics, that if you owned here, you were insulated from downturns, protected from cycles, shielded from consequences. For a long time, that story held. Then the conditions changed. Cheap money vanished. Remote work reversed. Insurance costs surged without warning. Short-term rental rules tightened. Carrying costs exploded. And slowly, without a headline or a panic button, the math stopped making sense. What followed wasn't a crash. It was worse, a freeze. Buyers stepped back. Sellers refused to adjust. Transactions slowed to a crawl. Entire neighborhoods went dark. The lights were on, but no one was home. Not full-time. Not invested. Not rooted. This isn't the kind of breakdown you track on a single chart. You feel it when you walk the streets on a random Tuesday night, when restaurants close early, when schools shrink, when essential workers commute hours just to keep luxury alive. Today, we're driving straight into that reality. Not the postcard version of Colorado's mountain towns. Not the marketing version. The real one. We're counting down 6 places where the housing market isn't correcting its coming apart. And with each stop, the illusion weakens. The risks sharpen. The consequences grow heavier. By the time we reach number 1, we'll arrive at a place most people still believe can never fall. The numbers disagree. Let's begin. Number 6. Silverthorne. Silverthorne was supposed to be the sensible option. For years, it sold itself as the reasonable alternative to nearby resort giants. Same peaks, same access, same lifestyle, just without the elite price tag or the suffocating crowds. It was marketed as a place where locals could still live, not just visit. That image didn't survive the boom. When demand surged, Silverthorne turned into a construction site. Condos rose quickly. Financing flowed freely. Developers assumed buyers would materialize simply because they always had before. The belief was simple. Build now, sell later. Later never came. New construction inventory surged at an alarming pace, climbing well over double in a single year. Entire buildings reached completion with no one inside. Listings that once disappeared in days now sit for months. Nearly half of sellers have already reduced their asking price, many more than once. But the visible price cuts aren't the real fracture. The deeper issue came when short-term rental restrictions hit. Zones once marketed as automatic income generators lost their appeal overnight. Projected bookings collapsed. Revenue assumptions unraveled. Properties that only worked on optimistic spreadsheets stopped working at all. And locals couldn't step in to stabilize the damage. The average household income in Silverthorne supports a home price far below current listings. Even after reductions, values remain detached from what year-round residents can afford. That disconnect isn't temporary. It's structural. Silverthorne's mistake was building for investors instead of communities. When speculation leaves, it doesn't hand the keys back to locals. It leaves behind inventory, debt, and silence. Number 5. Pagosa Springs. Pagosa Springs once felt anchored. It wasn't trying to be glamorous. It wasn't chasing elite buyers. It was quiet, steady, and grounded. A town built around people who actually lived there full-time. Then remote work arrived and changed everything. Suddenly, Pagosa Springs wasn't evaluated as a town. It was analyzed as a revenue model. Homes were purchased not to live in, but to monetize. Short-term rental listings multiplied. Prices ran far ahead of what local wages could ever support. For a brief moment, it looked like success. Then the town pushed back. Licensing caps tightened. Moratoriums appeared. Enforcement followed. The fragile framework holding inflated prices together snapped fast. Future bookings dropped sharply. Investors lost their cushion. The aftermath is impossible to miss. High-end inventory has surged. Homes sit unsold for extended periods. Roughly 1 out of every 3 sellers has already lowered their price, some repeatedly. But here's the trap Pagosa Springs is caught in. Local incomes support prices far below what's being asked. Investors are pulling out. Residents are priced out. There's no natural buyer waiting underneath the falling market. Pagosa Springs exposes a hard truth. When a town's housing values depend on short-term rentals to survive, removing that lever doesn't slow the market. It breaks it. Number 4. Crested Butte. Crested Butte built its reputation on being different. No gloss, No overdevelopment, no corporate shine. Just history, charm, and a sense of authenticity that felt increasingly rare. That image made it irresistible to wealthier buyers searching for something real. Prices followed. Then the buyers vanished. Sales volume dropped sharply. High-end transactions nearly disappeared. Homes began sitting for half a year or longer. Nearly half of current listings have already reduced prices. But housing prices aren't the only pressure point. Short-term rental freezes erased income potential. Insurance premiums surged due to wildfire exposure and geographic isolation. Some owners now face annual insurance bills rivaling full-time salaries. Crested Butte was sold as a place where there would always be someone richer waiting to buy. That assumption failed. Without constant demand at the top, the market lost its safety net. And when exclusivity no longer guarantees liquidity, prices don't just soften. They drift slowly, painfully, downward. Number 3. Steamboat Springs. Steamboat Springs tried to balance everything: a resort destination, a family-friendly town, a workforce hub, a luxury market. For a while, it looked like it worked. Then prices doubled, while wages barely moved. Families left. School enrollment dropped. Hospitals reported staffing shortages. Essential workers disappeared. The social backbone cracked. The housing market followed. Sales volume fell sharply. Condo inventory surged. Older units dropped significantly from their peak valuations. Properties that once felt attainable slipped out of reach almost overnight. Steamboat isn't losing tourists. It's losing residents. And when the people who make daily life possible disappear, markets don't stabilize. They unravel from the inside out. Number 2. Breckenridge. Breckenridge didn't stumble into trouble. It engineered it. The town became a machine designed to extract value from constant visitors. Short-term rentals weren't incidental. They were foundational. Leadership openly acknowledged that locals couldn't afford to live there while still expanding tourism dependence. Eventually, the tension snapped. Aggressive rental restrictions landed with force. Entire investment strategies collapsed. Projected rental income dropped dramatically in newly restricted zones. Properties that only made sense on paper stopped working in reality. The market reacted fast. Active listings surged sharply year over year. These weren't test listings. These were owners trying to escape carrying costs. Sales declined quarter after quarter. That's not hesitation. That's retreat. Walk through town and the shift is obvious. Storefronts sit empty. Hours are reduced. Weekends feel busy. But weekdays feel hollow. On paper, prices still appear strong. Behind closed doors, sellers are accepting deep concessions just to move on. Breckenridge didn't lose demand. It lost equilibrium. And when a town becomes a theme park without a community, the housing market has nothing stable to land on. Number 1. Aspen. There was never going to be another ending. Aspen isn't just a town, it's a symbol. For decades, Aspen represented the pinnacle of real estate ambition. A place where price didn't matter, where risk didn't apply, where economic rules politely stepped aside. That belief collapsed. Median single-family home values have fallen sharply from their peak. Properties once valued near $40 million are now trading far closer to the high 20s. Billions in paper wealth have vanished. Sales volume has dropped dramatically. Active listings have surged. Homes now sit unsold for most of a year. This is not a healthy market. Aspen didn't break because it lost beauty. It broke because the premium stopped making sense. Cheap money disappeared. Remote work reversed. Buyers with unlimited options started asking difficult questions. Why here? Why now? Why at this price? Luxury buyers found alternatives. New destinations offered modern homes, fewer constraints, and better value. Aspen's uniqueness hardened into inflexibility. The effects are spreading. Retail sales are down. Galleries struggle. Commercial revenue weakens. Most homes sit vacant most of the year. Aspen is no longer a living town. It's seasonal infrastructure. And when a bubble grows larger than anywhere else, it doesn't deflate gently. It fractures. By the time you step back and look at all 6 towns together, a pattern becomes impossible to ignore. These places didn't fail for different reasons. They failed in the same way, just at different speeds. Each town believed it was protected by something unique. Silverthorne trusted construction and proximity. Pagosa Springs trusted small-town stability. Crested Butte trusted authenticity. Steamboat Springs trusted balance. Breckenridge trusted volume. Aspen trusted mythology. What none of them accounted for was how fragile their foundations had become. Because beneath the views, beneath the lifestyle branding, beneath the illusion of endless demand, the same pressures were building everywhere at once. And when pressure builds quietly, the release is never clean. The invisible shift that broke everything. The collapse didn't begin with prices. That's what most people get wrong. Prices are the last thing to move. Liquidity moves first. Confidence moves even earlier. The first real crack appeared when money stopped being free. For more than a decade, borrowing costs were so low they erased consequences. Investors didn't need perfect math. They didn't even need good math. They just needed appreciation and leverage. If rents were short, refinancing filled the gap. If cash flow failed, price growth rescued the deal. That environment trained buyers to ignore risk. When borrowing costs surged, the entire logic inverted. Suddenly, appreciation wasn't guaranteed. Refinancing became painful or impossible. Monthly carrying costs exploded. Properties that once looked manageable turned predatory overnight. Mountain towns felt this shift faster than most places because their prices were already extreme. A small change in financing conditions didn't dent affordability. It obliterated it. Why buyers disappeared first? The assumption was that wealthy buyers wouldn't care. That assumption was wrong. Wealthy buyers care deeply about opportunity cost. They care about optionality. They care about flexibility. And they walk away faster than anyone else when value stops making sense. When prices peaked, buyers didn't rush in to secure property. They paused. They waited. They asked questions they hadn't needed to ask in years. Why lock capital here? Why accept these restrictions? Why pay these fees? Why tolerate insurance uncertainty? And once those questions were asked, the answers weren't compelling. The result wasn't a flood of panic selling. It was something colder. Buyers simply stopped showing up. The freeze that followed. Once demand vanished, the market entered its most dangerous phase: stagnation. Listings piled up, but sellers refused to adjust. Most owners didn't need to sell. Many had bought years earlier. Others believed the slowdown was temporary. They waited for spring, then summer, then next year. That waiting created a backlog. Inventory accumulated quietly. Days on market stretched. Price cuts became common, but cautious just enough to test interest, never enough to clear the logjam. This is how housing markets rot. Not through crashes, but through gridlock, the hidden costs that accelerated the damage. While sellers waited, costs kept rising. Insurance premiums didn't stabilize. They surged. In wildfire-exposed regions, some insurers stopped writing new policies altogether. Without insurance, financing dies. Without financing, buyers disappear. Homeowner association fees climbed as maintenance costs rose. Aging buildings demanded upgrades. Deferred repairs became unavoidable. Assessments multiplied. Property taxes adjusted upward, reflecting peak valuations that no longer existed in practice. Short-term rental income, once the safety valve, evaporated under new rules and declining demand. Suddenly, owning didn't just fail to generate profit. It generated stress. That's when patience begins to crack. Why locals couldn't save these markets. A common belief was that if investors left, locals would step in. That belief collapsed everywhere. Local wages never caught up with prices, not even close. Teachers, healthcare workers, service staff, and municipal employees couldn't qualify for homes even after meaningful price reductions. The result was a vacuum. Investors were exiting. Locals were locked out. Second home buyers were hesitant. There was no buyer of last resort. Markets don't correct without participants. They decay. The community collapse. No one modeled. Housing markets don't exist in isolation. When full-time residents leave, everything weakens. Schools shrink or consolidate. Hospitals struggle to staff. Emergency response times increase. Restaurants shorten hours. Retail closes earlier. Tourism can't replace community. It can only mask its absence temporarily. And once daily life erodes, desirability follows. A place can be beautiful and still fail as a market. The myth of scarcity finally broke. Scarcity was the final illusion to fall. These towns believed limited land guaranteed endless demand. But scarcity only works when buyers believe value will persist. When confidence disappears, scarcity becomes a liability. Few buyers means fewer transactions. Fewer transactions mean less price discovery. Less price discovery means paralysis. Illiquid markets don't bounce. They sink slowly. Why this is not a short-term cycle? Many sellers are still waiting for a rebound. They shouldn't be. This breakdown isn't tied to a single policy or a temporary rate environment. It's structural. Remote work has recalibrated. Tourism growth has normalized. Insurance risk is permanent. Regulatory pressure isn't reversing. Demographics are shifting older, not younger. The conditions that inflated these markets are gone. They aren't coming back in the same form. What happens next? The next phase won't be dramatic. There won't be mass foreclosures. There won't be fire sale headlines. Instead, there will be continued inventory buildup, longer selling timelines, quiet price erosion, growing disparity between asking and closing prices, increasing pressure on over-leveraged owners' sides. Over time, reality wins. It always does. What buyers need to understand. For buyers, this moment isn't an opportunity by default. Cheap listings don't mean good value. Falling prices don't guarantee bottoms. True opportunity comes later when pricing aligns with local wages, when liquidity returns, when communities stabilize. That hasn't happened yet. Patience is not passive, it's strategic. What sellers need to accept. For sellers, the hardest truth is also the simplest. The market doesn't care what your property used to be worth. It doesn't care what your neighbor sold for 2 years ago. It doesn't care what you need. It only responds to demand. And right now, demand is selective, cautious, and unforgiving. The final pattern. From Silverthorne to Aspen, the story is the same. This wasn't organic growth. It was leverage, speculation, cheap money, mythology. Short-term rentals inflated values. Investors replaced residents. Costs exploded. Demand vanished. What remains are stunning places, struggling under the weight of their own success. This is not a correction. It's a reckoning. For buyers, it's a warning. For sellers, it's a reality check. For towns built on illusion, it's the bill coming due. Avalanches don't start at the bottom. They start with pressure at the top. And once they move, no one knows how far they'll run. If this breakdown helped you see past the headlines, share it with someone who needs to understand what's really happening. Let us know which town surprised you most and where we should go next. Thanks for being here. Stay sharp, stay grounded, and stay safe out there.